We don't avoid the healthcare sector in total. So we goes back to our investment philosophy, what I said at the beginning. So we try and find businesses where we don't have to predict. So a lot of healthcare does involve prediction. Is this drug better than that drug? Do the trials say this drug is better than that drug? So, and we're not experts at that, and we don't pretend to be experts. So we stay well away from that. It is regulated. I do have some concerns when I look at, especially the US, when I look at the amount of money that they spend on healthcare relative to the outcomes, and I look at the cost of drugs in Canada, say, versus the US, which, to be fair, has been like that for a very long time. There's obviously a lot of pressure on generics and also the whole political argument around cost for all, drug prices in third world. So there's a lot of political regulatory risk around all of that, and there's a lot of product risk around forecasting whether this is going to be a good drug or not. So that's probably the first thing that I would say. We do look at healthcare, but what we try to do it in ways that are not, again, I don't have to forecast what is it going to happen. So, for example, we would look at an area like medical instruments, med tech. We would be interested in hospital supplies, anything like that which participates in the growth, but is not very product heavy. A great example would be something like Zoetis, which was spun out of Pfizer, which was their veterinary business, which is a pharma business. So for us, there's a couple of things about that business that I think are different to the average pharma business. The first thing is it's predominantly privately funded. So that takes off a lot of that risk that I was talking about earlier, about political risk and the cost of drugs and everything else. So it's privately funded. It's direct to consumer, so it doesn't go through all these complicated distributor processes that you have in the States. Another thing I like about the business is the average drug that they sell is 28 years old, and 80% of the drugs they sell are off patent. So the reasons people are buying that are much less complicated, and the funding is much less complicated. And we all know that, especially through COVID, everyone wants to have a pet. Now we've got even more pets since COVID. So that is kind of the type of healthcare business we'd be in. Again, it's if we can avoid the forecasting and being ahead of everyone else on predicting, if we can avoid the product complexity, if we can avoid the regulation and avoid the funding risk, and it ticks all those boxes, and there's good secular growth, then we're definitely interested. It's just at the wrong price now. It's interesting that the S&P is back at an all-time high. So the market's back where it was in January, February. I'm not 100% convinced the world is quite back where it was in January, February. So that, I think, to my mind, is interesting. I think a lot of people are justifying valuations on the current low interest rates. I'm not 100% convinced about that either, because my question to that person would be, well, why are you willing to accept a lower return when arguably the risks are demonstrably higher than pre-COVID? So if I look at our portfolio, we target a return of 8 to 12% for our clients. It's an absolute return through the cycle. We're not relative investors. We don't benchmark relative to interest rates. We benchmark relative to inflation and relative to history. And definitely at the moment, that targeted return will be right at the bottom end of that range. But I would say arguably the risks at the moment are as high as they have been in my career, with the exception possibly of the GFC. There's a lot of unknowns out there at the moment. So that's probably, I would say, relative to risk. I'm not quite sure that market valuations reflect the potential wide range of outcomes that are out there. We never start an investment meeting going, will there be a vaccine? What are interest rates doing? It's purely bottom-up business forecasting, right? But at the end of the day, we do like it if there's a lot of uncertainty that we get paid to take the uncertainty. So if you look at when the fund started, in 2011, that was just after the GFC, we had the Eurobank crisis. And you could buy very good businesses at 13 and 14 times earnings. Those businesses now trade at probably 27 or 28 times earnings. But the risk arguably has gone up since then. So that's something that I would think about. I think, so valuation, just risk return, I don't think is very favorable. But there's other things to think about as well. I think probably for all of my investing career, we've lived in a world which was globalizing, where the world was kind of coming closer, if you like. During a time when the US and the UK to some degree were the benchmark, if you like, free markets, open economies, we seem to be moving away from that to some degree in the last few years. The US is at war with itself, if you like, and it's not on great terms with its allies nor its so we're ending up in a bit of a kind of fractious world there. Those things we took for granted from a business point of view, I'm not talking about a market point of view, that markets would be open and we would have access. I think those things are definitely in question. And I think the other thing I would probably also call out is just the wealth gap. It's as high as it's been since 1929. And that can lead to dangerous political outcomes, I think. So I think there's a few things going on at the moment, and the world's always uncertain, by the way. In my investment career, I've lived through hyperinflation in Zimbabwe, the Asian crisis, the tech wreck, the bank crisis, Trump. There's always something to worry about. But if there is, you'd like to be able to have the odds on your side. I'm just not convinced the odds are on our side at the moment.